Do you want to learn the investment strategies of Warren Buffett? Then this video is for you. Investors have long praised Warren Buffett's ability to pick which stocks to invest in. He has resisted the temptations associated with investing in the next big thing, and has also used his immense wealth for good by contributing to charities. With his uncanny ability to uncover long-term profitable investments, it's understandable most investors would like to know exactly what Buffett looks for in a stock. Value investing for choosing stocks. Understanding how Warren Buffett selects winning stocks starts with analyzing the investment philosophy of the company he is most closely associated with, Berkshire Hathaway. Berkshire has a long-held and public strategy when it comes to acquiring shares. The company should have consistent earning power, a good return on equity, ROE, capable management, and be sensibly priced. Buffett belongs to the value investing school, popularized by Benjamin Graham. Value investing looks at the intrinsic value of a share rather than focusing on technical indicators, such as moving averages, volume, or momentum indicators. Determining intrinsic value is an exercise in understanding a company's financials, especially official documents such as earnings and income statements. There are several things worth noting about Buffett's value investing strategy. To guide him in his decisions, Buffett uses several key considerations to evaluate the attractiveness of a possible investment. How has the company performed? Companies that have been providing a positive and acceptable return on equity, ROE, for many years are more desirable than companies that have only had a short period of solid returns. The longer the number of years of good ROE, the better. In order to accurately gauge historical performance, an investor should review at least 5 to 10 years of a company's ROE. When looking at a company's historic return on equity, ROE, it's also essential to compare this with the ROE of the company's top competitors in the same industry. How much debt does the company have? Having a large ratio of debt to equity should raise a red flag because more of a company's earnings are going to go towards servicing debt, especially if growth is only coming from adding on more debt. Instead, Buffett prefers earnings growth to come from shareholders' equity, say. A company with positive shareholders' equity means the company generates enough cash flow to cover its liabilities and is not relying on debt to keep it afloat. For Buffett, low debt and strong shareholders' equity are two key components for successful stock picking. How are profit margins? Buffett looks for companies that have a good profit margin, especially if profit margins are growing. As is the case with ROE, he examines the profit margin over several years to discount short-term trends. To stay on Buffett's radar, a company's management should be adept at growing its profit margins year over year, a sign that management is also good at controlling operating costs. How unique are the company's products? Buffett considers companies that produce products that can easily be substituted to be riskier than companies that provide more unique offerings. For example, an oil company's product oil is not all that unique because clients can buy oil from any number of other competitors. However, if the company has access to a more desirable grade of oil, one that can be refined easily, then that might be an investment worth looking at. In this case, the company's desirable grade of oil could be a competitive advantage that helps it earn profits through greater sales and margins. How much of a discount are shares trading at? This is the crux of value investing, finding companies that have good fundamentals but are trading below where they should be. The greater the discount, the more room for profitability. The goal for value investors like Buffett is to discover companies that are undervalued compared to their intrinsic value. An opportunity to buy at a discount exists when a company's current market value is cheaper than its intrinsic value. While there is no exact formula for calculating intrinsic value, investors will look at a variety of factors such as corporate governance and future earnings potential to estimate intrinsic value. What strategy does Warren Buffett use? Warren Buffett's investing strategy is value investing. Value investing involves selecting stocks whose share price is trading below its intrinsic value or book value. This signals that the market is currently undervaluing the stock and that the stock will rise in the future. What are Warren Buffett's investing principles? Warren Buffett has many investing principles, but one of the most important he stresses is investing in yourself. He has stressed that making yourself smarter and wiser can help you become a better investor. He also believes investing in yourself includes having good financial practices, such as not overspending beyond your means, avoiding credit card debt, saving, and reinvesting your profits. What companies does Warren Buffett own? Through his company, Berkshire Hathaway, Buffett's largest holdings are Apple, American Express, Bank of America, and Coca-Cola. Beyond his value-oriented style, Buffett is also known as a buy-and-hold investor. He is not interested in selling stock in the near term to realize capital gains, rather, he chooses stocks that he believes offer good prospects for long-term growth. This leads him to move focus away from what others are doing. Instead, he looks at whether a company is in a solid position to make money moving forward and if its stock is sensibly priced. Warren Buffett, who many consider the most successful investor of all time, rarely changes his long-term value investment strategy. In fact, he regards down markets as an opportunity to buy good companies at reasonable prices. We will cover the Buffett investment philosophy and stock selection criteria with specific emphasis on their application in a down market and a slowing economy. The Buffett investment philosophy. In times of economic decline, many investors ask themselves, what strategies does the Oracle of Omaha employ to keep his holding company, Berkshire Hathaway, on target? Buffett has a set of definitive assumptions about what constitutes a good investment. He focuses on the quality of the business rather than the short-term or near-future share price or market moves. He takes a long-term, large-scale, value-based investment approach that concentrates on good fundamentals and intrinsic business value, rather than the share price. Buffett looks for businesses with a durable competitive advantage. What he means by this is that the company has a market position, market share, branding, or another long-lasting edge over its competitors that either prevents easy access by competitors or controls a scarce raw material source. Buffett employs a selective contrarian investment strategy. Using his investment criteria to identify and select good companies, he can make large investments, millions of shares, when the market and the share price are depressed and when other investors may be selling. In addition, he assumes the following points to be true. The global economy is complex and unpredictable. The economy and the stock market do not move in sync. The market discount mechanism moves instantly to incorporate news into the share price. The returns of long-term equities cannot be matched anywhere else. Buffett's investment activity. Berkshire Hathaway is the main vehicle for holding Buffett's investments in a wide range of industries over the years. These have included the likes of insurance, technology, banks and financials, airlines, soft drinks, private jet aircraft, chocolates, shoes, jewelry, publishing, furniture, steel, energy, home building. The industries stated earlier vary widely, so what, then, are the common criteria used to separate the good investments from the bad? Buffett's investment criteria. Berkshire Hathaway relies on an extensive research and analysis team that goes through reams of data to guide its investment decisions. While all the details of the specific techniques used are not made public, the following 10 requirements are all common among Berkshire Hathaway investments. 1. Candidate company has to be in a good and growing economy or industry. 2. It must enjoy a consumer monopoly or have a loyalty commanding brand. 3. It cannot be vulnerable to competition from anyone with abundant resources. 4. Its earnings have to be on an upward trend with good and consistent profit margins. 5. The company must enjoy a low debt-to-equity ratio or a high earnings-to-debt ratio. 6. It must have high and consistent returns on invested capital. 7. The company must have a history of retaining earnings for growth. 8. It cannot have high maintenance costs of operations, high capital expenditure, or investment cash flow. 9. The company must demonstrate a history of reinvesting earnings in good business opportunities, and its management needs a good track record of profiting from these investments. 10. The company must be free to adjust prices for inflation. The Buffett strategy. Buffett makes concentrated purchases. In a downturn, he buys millions of shares of solid businesses at reasonable prices. Buffett does not buy tech shares because he doesn't understand their business or industry. During the dot-com boom, he avoided investing in tech companies because he felt they hadn't been around long enough to provide sufficient performance history for his purposes. And even in a bear market, although Buffett had billions of dollars in cash to make investments, in his 2009 letter to Berkshire Hathaway shareholders, he declared that cash held beyond the bottom would be eroded by inflation in the recovery. Buffett deals only with large companies because he needs to make massive investments to garner the returns required to post excellent results for the huge size to which his company, Berkshire Hathaway, has grown. Buffett's selective contrarian style in a bear market includes making some large investments in blue-chip stocks when their stock price is very low. And Buffett might get an even better deal than the average investor. His ability to supply billions of dollars in cash infusion investments earns him special conditions and opportunities not available to others. His investments often are in a class of secured stock with its dividends assured and future stock warrants available at below-market prices. How did Warren Buffett make his money? There isn't one specific way that Warren Buffett made his money, rather, he made it over many years through a variety of steps. These steps include saving at a young age, reinvesting profits, finding a mentor, and living within your means. Buffett did also take control of Berkshire Hathaway, a textile manufacturing company, which he eventually turned into a holding company, using it to purchase many other companies, which allowed him to increase his wealth. Buffett's strategy for coping with a down market is to approach it as an opportunity to buy good companies at reasonable prices. Buffett has developed an investment model that has worked for him and the Berkshire Hathaway shareholders over a long period of time. His investment strategy is long-term and selective, incorporating a stringent set of requirements prior to an investment decision being made. Buffett also benefits from a huge cash war chest that can be used to buy millions of shares at a time, providing an ever-ready opportunity to earn huge returns.